China, Japan, and the United States are all selling US Treasuries, and central banks around the world are buying gold instead. This central bank activity is having impacts on the market, and it will continue to have an impact on the market for years, if not decades to come. So the first big seller of US Treasuries, we cannot ignore the United States Treasury themselves. Anytime the US government borrows money, that is the same thing as them selling or issuing a new treasury. The national debt is currently above $36 trillion. And with the deficit already at $710 billion since October of 2024, the US government is borrowing like never before, which means it is selling treasuries like never before. But we also can't forget about the Federal Reserve, the central bank in the United States. This is their balance sheet. And you can see when this chart goes down, that is the Federal Reserve selling treasuries that it has previously bought. This means what has been happening for the last couple of years is the opposite of QE. When QE is happening, quantitative easing, the Fed is printing money to buy up US Treasuries. That drives the price up, that drives interest rates down. Instead, what has been happening for the last couple of years is the opposite. The Federal Reserve has been selling very slowly treasuries off of their balance sheet, which has the opposite impact of money printing. All else being equal, this would decrease the money supply. Now we know all else is not equal. Many financial institutions, like banks, are doing the opposite. They are lending money into existence and they are buying US Treasuries. But the United States is not the only player in town here. We are also going to need to look at the other two very large players, China, Japan. China and Japan have both been selling US Treasuries at near record paces. This is a big deal because China and Japan are the biggest foreign holders of US Treasuries. Now, according to the US Treasury's internal data, Japan and China, as of November of 2024, are still the largest foreign holders of US Treasuries. But if they continue selling, they could lose that top spot soon, considering the UK is not far behind China. So China, Japan, and the Fed are all actively decreasing their exposure to US Treasuries, with China about to drop below the UK in terms of the total treasuries it holds. Now, you might look at how many treasuries the Fed owns, and just by looking at their total balance sheet, you might assume that they have a very large, historically speaking, balance of US Treasuries. But if instead we look at this as a percent of the total debt that is available, we can see that the Federal Reserve's holding of US Treasuries is back down to very close to average levels. The Fed owns about 15% of the US government's debt that is held by the public. And while that percentage has been pretty volatile, ranging from 7% up to 25% over the last 2 decades, being around 15% where it is right now is much closer to historical norms going back to 2003. This is one of the reasons why bond yields have continued to rise over the past few years, because US Treasuries are being sold by everyone to a much larger degree than they are being purchased. We are seeing US Treasuries be actively replaced around the world, especially on central bank balance sheets, and it is being replaced by gold. This is a chart that shows the monthly reported central bank activity in terms of purchases or sales of gold. Let me explain what you're looking at here. Across the middle, there is the zero line. Any blue bar that shows up above the zero line represents a purchase, and any purple bar that shows up below the zero line represents a sale. Together, we can net these out to see total net purchases versus net sales and come up with the black line that jumps around from bar to bar. And you can see that over the past 2 years, every single month outside of just a couple of months in 2023, net purchases by central banks have outpaced net sales. This is the main reason why the price of gold has risen so dramatically over the last couple of years as well. In fact, in just the last 1 year, the price of gold is up about 35%. Now, many times the price of gold will go up because there's large purchasing of gold in anticipation of future inflation, future money printing to handle debt crises by sovereign governments. Now, This time, that is certainly one of the reasons why we are seeing gold be purchased at the pace that it's being purchased right now. But another reason is simply because it is a safe haven asset that maintains its purchasing power, and it has done so for thousands of years. It represents an asset that is not somebody else's liability, and in times of rising geopolitical tensions and uncertainty about the foundation of the global financial system, in other words, US debt, owning gold becomes less of a luxury and more of a necessity. Now, I'm not making the case that any country anywhere in the world is going to make any sort of a successful push back towards some sort of a gold standard anytime soon. But what I am saying is that as a savings account, nothing has beat gold for thousands of years, and as a way to preserve your purchasing power, it is still the king. Now, the fact that everybody is selling US Treasuries and yields are rising is probably going to have an impact on other things like the stock market as well. If you take a look at this very interesting chart, we are seeing two lines. The blue line is the earnings yield of the S&P 500. The pink line is the yield on the US 10-year Treasury. So the earnings yield is the percentage profit that companies that are a part of the S&P 500 generate. And when we take a look at these two yields compared to each other, we notice something very interesting. There was very little correlation between US Treasury yields and the yield of the S&P 500 from the early 1900s up until the 1960s. A lot of that had to do with the Federal Reserve's yield curve control, as well as the fallout from the Great Depression and the World Wars. However, once we get to about the 60s, we can see a fairly tight correlation between the 10-year yield and the S&P 500's earnings yield. They rose pretty much in lockstep from the 60s until the end of the 70s, and then have fallen pretty much in lockstep for the last 40 years. But if we zoom in here recently, we can see that there has been a dramatic rise in the yield of the 10-year Treasury that has not yet been followed by a dramatic rise in the S&P 500's earnings yield. Now, this could just be noise, but if you think about the implication of what this chart is showing you, it would make sense to see a correction upwards in the earnings yield of the S&P 500. Because if I invest $100 in the S&P 500, right now I'm gonna get back about 3%, a little over 3% in terms of the profit that those companies are going to generate for me. Now, as just a shareholder, I'm not gonna have any influence over whether all of those profits will be passed back to me or not. But what is true is that if you look at investing in the US 10-year Treasury right now, you'll get about 4.6% back on your money guaranteed for the next 10 years, which you cannot say about the S&P 500 because stocks necessarily have risk inherent to them that US Treasuries do not. And so in a very real sense right now, you are paying a lot more for income by investing in the S&P 500 than you are by giving it to the US government. Now, I'm not making the case that that is a good bet, but what I am saying is that many people will think that is a good bet. This is the crowding out effect. Imagine if the US government was offering 20% on its bonds. Everybody would sell all of their stocks and just give their money to the US government instead, because that's guaranteed, the market is not. And until the market, companies in the stock market were offering dividend yields of 10, 15, 20, 25, 30%, it would be very hard to compete with the US government. Now, given the fact that we are in the next phase of a long-term debt cycle, that the next decade or 2 decades will probably look very similar to how it looked from 1940 through 1980, very different than what we've experienced for the last 40 years, with falling inflation and falling interest rates and growing debt. Instead, what we're probably going to see is a very long and extended inflationary deleveraging, where the US government, individuals and institutions have to deleverage, happens through inflation as interest rates and prices continue to rise. Which means in the short term, we are very likely to see some volatility, but also reversions to the mean. And when you look at charts like this, they would imply that somehow, in some way, we should expect the profits of the companies inside the S&P 500 to play catch up. And that can happen from profits increasing, but it can also happen from the stock prices themselves going down. Now, by the way, if you would like to know the way that I am investing for the long term, given everything that I know about how the economy works, I've just released for free a mini series I call the 11th Century Stocks. And in it, I detail for you, number one, my portfolio that I believe could generate very strong returns for the next 100 years. But number two, I show you my process for selecting these individual stocks so that you can do it for yourself. And number three, I show you the way to automate it so that you never have to think about it and you can build your long-term portfolio on autopilot. This mini series is absolutely completely free. You just need to click on the link in the description below, enter your email, and you'll have it. As always, thank you so much for watching. Have a great day.